morning. Welcome to this webinar about integrated strategic, financial, and operational planning and performance management. It's being presented by the Operational Excellence Society. The Operational Excellence Society began as a small LinkedIn group that was started by Joe Paris. It grew into a larger grassroots group, now comprised of some 67,000 members. It has since grown beyond LinkedIn into a nonprofit think tank that's comprised of volunteers, me being one of them. We promote the principles of operational excellence while sharing knowledge and points of view. An important point to note is that these perspectives are technology agnostic. The website provides further details about the OpEx group. You're welcome to view it at any time. Also provided on the website is a body of knowledge. In it, you'll find articles like the productivity management one shown on the screen, which I wrote. Also on the site are the bios of those on the board of advisors, me being one of them. My name is Dean Sorensen, and I will be your presenter today. Before starting, let's address a few administrative issues. All lines will be muted during the webinar. You can ask questions by using the Q&A button at the bottom of the screen. You'll need to hover over the bottom of the screen for the bar to appear. Time permitting, questions will be addressed at the end of the webinar. Within a day, you'll receive a link to the recorded copy of the webinar. The contents of the webinar will also be used to facilitate discussion on a number of topics within the LinkedIn group. These discussion topics will be summarized at the end of the webinar. If you'd like to participate in these discussions and aren't a member of the group, please feel free to become one. So before starting, let me share a little bit about myself. I help organizations to improve strategic, financial, and operational planning and performance management processes, examples of which are shown on the screen, which include things like a balanced scorecard, activity-based costing, sales and operations planning, anything relating to planning and managing a business. And more specifically, I specialize in helping organizations to integrate these processes in support of finance and enterprise transformation that institutionalize operational excellence and process management. Much of this experience was gained through employment with accounting and consulting firms that you might know, like A.T. Kearney and Accenture. Now, of relevance to our discussion today will be my experience in integration-related issues. So, for example, for a software company, I helped develop an integrated financial planning, integrated business planning solution. For a consulting company, I developed an integrated performance management service offering. And I also worked for an integrated business planning and prescriptive analytics software company. But one of the things we'll find here is that I think there's a lot of confusion about what these terms mean and how they're different. And really, the question I get a lot is, what's the difference between these things? And in many cases, one of the reasons for this is that they really represent outdated and immature processes and technologies. So one of the things that I'm going to use is a generic term that I call integrated strategic, financial, and operational planning and performance management processes. And this will be our focus today, just this how all these things fit together. And in a short term of this is integrated, you'll see the term on there, but I'll use this term throughout the presentation. So the key questions that we're going to ask today is, how does this integrated process eliminate functional silos while simultaneously enabling companies to manage complexity? So these are two highly interconnected issues. And how do these processes institutionalize operational excellence principles like systemic thinking, customer centricity, and you can see others on the screen? And more specifically, what problems are they solving? What are they worth, and who benefits from them? What comprises them? So these are some of the questions that we'll be asking today. So by way of an agenda, here is a list of what we'll be talking about. So first off, what I'd like to do is provide a few key perspectives before we get started. Then we'll talk about functional silos in current state. I'll, I'll illustrate that with a case study that illustrates the impact of fragmented processes. Then we'll talk about framework for productivity management, mature planning and processes, and prescriptive analytics and how that fits in. Then we'll talk about how these things fit into an integrated process and what key changes they introduce. I'll provide you with a maturity model that talks about, how you could think about the maturity of planning and performance management processes in the technology landscape. We'll wrap up with end up with a case study, and then we'll have some summary and questions. So during the course of this webinar as well, I'll be pointing out some articles that I've written that provide further details on these topics. So there's 3 separate articles that I'll share. So first off, let's talk about some of the key perspectives. So first off, one of the things when we talk about planning and performance management and the integration of them, one of the things I think that's important to understand is that the central focus of integration is around planning and managing outcomes, and that when we get to the end, you'll see there's really 4 incremental capabilities that glue all this together. And that addressing these things get increasingly difficult as companies get complex. So achieving integration is more complex. And as well, one of the things that we'll be talking about is the interconnected challenges that finance, operations, and strategy and operational excellence people address. Now, I'm not going to address this slide right now in a lot of detail. Just know that throughout the course of this webinar, I'm going to be talking about financial and operational and strategic challenges, and we'll come back to this at the end of the webinar. The other thing that we'll be talking about, if you look at a lot of the types of technology and processes that companies have implemented over in recent years, that there's some gaps in those, and I don't think that they're as mature as companies would like them to be. So we'll be talking about what the gaps are and how to fill them. Another thing to understand is that as I'm talking here, I'm going to be providing you with a high-level overview, so we're not going to go into a lot of detail on each, but what I want to be able to do is give you an understanding of what sorts of things do you need to understand in order to ask the right questions. So you'll know what sorts of education does your company need to get in order to integrate your processes and systems. So that's a quick high-level overview. Let's get into the functional silos part. So the first thing is this webinar and this specific section really builds off an article that I wrote called Productivity Management, and you can see it here. It's on the website. So I'm just going to quickly give an overview of what I talked about in that article. So first off, one of the things that we talked about in the article was that, functional silos, various research studies just confirm that, it's a real barrier in terms of achieving, so many different strategic objectives like customer experience, digital transformation. You can read them all. Bottom line is that, functional silos are a bad thing. And one of the reasons why they're a bad thing, as I raised in the article, is that, the way we plan, manage, and govern our business is still very much along vertical lines, while our strategy and customer value propositions are horizontally driven. So we have this alignment paradox. And one of the reasons why this is that our financial processes are still focused vertically, especially our budgeting processes. Now, I think some companies have moved to what we call rolling forecasts, but for the most part, these rolling forecasts are still very functionally driven and don't address this alignment paradox. And one of the problems that we have is that companies can't manage the intersection points between functions and processes. And so, in other words, one of the things they really can't do is connect inputs with outcomes and outputs. So this is a challenge that companies have. And one of the things I raised in the article was this idea or capability called matrix processes. So at the output of the process would be something like this, where functional and business process costs are always reconciled from both an actual and forward-looking perspective. The net result being process costs that are regarded as being accurate. And I think from From an operational excellence perspective, this is, or a process management perspective as well, this is a real barrier to institutionalizing these sorts of ideas. So what that gives us then is the ability to manage productivity. So in the case of an order to cash process, a cost per order. And when I marry that with, key performance indicators, I now can manage what I call the trade-offs associated with this process. So the idea being that, perfect order fulfillment, as the perfect order fulfillment rate goes up, all other things being equal, your cost per order will go up. So the idea is that what you really want to be doing when you're managing a business or managing a process is manage these trade-offs. And these trade-offs can be arranged in a hierarchy. So I can distill cost per order at a high level down to cost per pick in a warehouse. So just having that hierarchy. So one of the things that gives us is the ability to coordinate cross-functional activities, establish joint rewards and recognition, and ultimately establish governance and decision rights that are horizontally driven. But one of the things that managing this way also helps organizations do is optimize performance, because really what this is a formal optimization mechanism whereby companies and process and department owners are always looking to manage the trade-off between these things. It also enables effective employee engagement. So essentially what this sort of framework does is it enables companies to act like business owners, because a business is always comprised of conflicting objectives, and this is really what we're doing. So this whole idea of a business owner mentality is a big benefit of being able to manage this way. Now, one of the things in that article I had was a list of research studies that I had pulled together, and I'm not going to go through each of them, but you can read them on your own, but I'll just point out a couple. That if you look at research studies on complexity costs, the numbers are big. So in the one that I look at is the estimated cost of complexity is 3 to 5% of sales, and that's actually fairly consistent with my experiences as well. But as well, I mean, some of the things that companies are trying to do, especially things like profitable growth, that a lot of companies really aren't doing it all that well. So in the research study by Bain, only 11% grew both revenue and profits. And I think that one of the reasons why companies can't do that is because they can't manage these trade-offs. So the reason why companies have these difficulties is that they can't manage these, what I call unintended consequences as they get bigger. They can't see the unintended consequences coming. They don't have the visibility. They can't connect targets to outcomes and processes. They don't, people aren't incentivized to do so, and the processes are too slow to react to change. So I've actually summarized these things in another LinkedIn article that you can read by yourself. You can go to my LinkedIn page and look up the article, but it outlines this in a little bit more detail. So the key takeaway from this section is that, when we talk about productivity and trade-off management, the value is significant. And I think that one of some of the questions that we have to deal with, which we'll talk about, is how to change financial processes while actually simplifying and supporting the business. So first thing one of the things I'd like to do is illustrate this with a case study. So first off, this particular case was a publisher of school books. It's a fairly big company in the billions of dollars. They had a significant deterioration in performance, high inventory, stockouts, and back orders, and it followed a long annual planning process. So our focus was to fix the problem and provide some insight on, an ERP investment that they had been contemplating. So what ended up happening is that we actually recovered control, but what ended up happening is that the challenges they had wiped out about half of their profits for the year. But the key conclusions was that they had ineffective planning processes, and the supply chain group that we were talking to or focused on was actually understaffed significantly, and the problems were going to get even bigger in the future. So when we were talking to the finance person, the CFO actually, I think their reaction was, gee, that's really doesn't jive with my understanding of the business. You'll have to explain to me how you got to that conclusion. So what I'm going to describe to you is just how we actually help them come to that conclusion. So just before I get too deep into this, one of the things I also want to talk about is that this company was actually an early adopter of many of these things that you'll see on the screen. And when we get to the end, you'll see that's really an illustration of some of the gaps in some of these processes. So, like I said, the company was a publisher of school books, and the numbers I have here I've just simplified just for illustration purposes. But X number of years ago, school book companies would have, they'd produce like a history book that was used all across, say, a country. In the United States, it would be everywhere in the United States. And, that was a fairly simplistic book. But as time went on, different states or different cities would want their own history book. And, also what ended up happening is that, they started providing teachers' aids, and a whole bunch of other things that went along with the book. So the idea being that a book is not a book anymore. So this is how it break out is, the A items were the simple ones for the production inventory planners to manage. The D items were the most complicated ones. And you can see the mix of the number here. So this is how they thought about how that they would manage. This is the number of reviews that the inventory planners would do per year. You can see the D's they would need to review them once a week, and the simplistic ones with more steady demand, they spent less time on. This was the hours per review, and from this you could deduce that historically this is how many hours they needed and how many people that they needed. Well, of course, this was the basis for what was included in the financial planning and budgeting process. And so what they were really budgeting for was like a $300 per book. Of course, then you look at what was actually really happening. So from that time, the mix had actually changed. So if you just do the math, because you've got more of these more complicated books, you actually need this many people to run the department. And they were maintaining their budget by reducing the number of reviews. In other words, what they did was that they reduced the service level actually without telling anybody. And in fact, if you look at their strategy, they were headed towards more complicated books, digital transformation, that kind of thing. So the problem was actually going to get a lot worse. So within 5 years, they were going to be short-staffed, over 100 people, at which point the CFO thought, oh my God, I had no idea this was happening. And what the department head said, this is what I've been trying to tell you, it's just we've never been able to articulate it this way. So when I get to the end, I'm going to mention this again, but this really talk about the significant differences in different segments of the business and the impact of mix changes. It's a big deal. So what this did was really kind of highlight a couple flaws. First, problem with financial driver-based planning is that a lot of these models are maintained by finance, and they're hard to manage, and the averages actually mask the impact of operational challenges. And conflicting business objectives aren't always articulated. So for example, how service levels affect staffing and budgets is not always totally understood. And then an understanding of how strategy affects operations. So the company actually totally missed the fact that their strategy was driving them this direction, and had totally undervalued the impact of these changes on the value of an ERP investment. In fact, after we had this discussion, the company started, actively pursuing ERP the day after we presented this. But just from a process perspective, a couple things happened. The company and this particular person that was running this department, one of the things that we did, given the information that we gave her, she continued to use the spreadsheets that we developed for her to support her budgeting and rolling forecast process. So from a budget perspective, we took her budgeting cycle time from about 2 months down to less than 2 days. And the big change of this related to the fact that, there was no more game playing. There was a pretty specific conversation, which was, you tell me what you want, how many books you want me to manage. You tell me what service levels you want. I'll tell you how many people I need. The whole focus changed. As well, just from a cultural perspective, one of the challenges that the company experienced, or this department experienced, was that the employees were actually really under a lot of stress because they just weren't properly staffed, and it was really impacted the motivation within the group. And one of the things that was actually causing this were what I call these sort of unwritten rules that are causing kind of the wrong behaviors. So if you look on this slide, many companies that have these traditional budgeting processes have these unwritten rules. And the three in the red at the top were exactly how this department head manager managed. So always under promise and over deliver, never submit your real budget. I mean, most companies, when I talk to them, have these sorts of unwritten rules. And the reason why they're there is because they don't believe resource allocation and target setting is fair. And, these beliefs are really counter to the strategies that most are pursuing. So when you think that, when you look at the fact that most believe that the focus is really on the budget, irrespective of what anybody says, people start believing that, well, maybe this operational excellence thing is just a fad. And you can see the other things on this. They're just really very destructive. And the thing is that until you get to the point where you can connect, what you're trying to achieve with the resources, with the resourcing, getting the assumptions right, you're never really going to get rid of these things. Now, one of the things that we did, like if you think about how this would be implemented as part of a system, if you look at these sorts of spreadsheets, this is what you might actually see in a system, with the months at the top. But I think one of the things that we're showing is how you integrate a process which incorporates the answers to these questions, like how many people do we need, how much will we spend on what activities and are we spending, and how productive will we be. This is what a good process should answer. And the thing here, where I talked about matrix planning before, this matrix is done at a departmental level for every department. This is how it's maintained. And underneath all this is, answering the questions: what's driving the work? How many? In this case, it's a number of items. What service level? So it's a very explicit dialogue. And this is what we mean. One of the things that we mean by integrating strategic, financial, and operational planning and performance management processes. So the key takeaway from this is that the integration of these processes actually solves a problem, I would say, for very many departmental managers. And one of the problems that most departmental managers have is they can't manage expectations. And I hear that over and over again. This expectation management problem and solving it is a key driver of actually under the operational excellence principles. So what this illustrates is that you can have a much faster and more cost-effective process, and by using shared models and distributed ownership of this of the planning models. So that's the case. So what I'd like to do now is just take this and show how you use this in from a productivity management perspective. And this is actually driven by the article that I mentioned to you before about productivity management you'll find on the Operational Excellence website. So start off with this slide that we had in the last section. And what I want to do is show that we can actually take this cost per order, as well as the cost from other processes, and actually help derive the profitability of a customer, and actually segment. So how, what's it costing to deliver, how satisfied are we? Can we actually understand where our customers sit on a portfolio? And then a big part of this as well is having ongoing activity-based costing to deliver this sort of insight. And we can do likewise with a portfolio management system. So one of the things about a good integrated process is that you should always know the value of potential improvement efforts. And one of the challenges is that in that project and portfolio management is this is often a very manual process. So what I'm suggesting here is that this should be a very integrated process. So let me say, one of the things I want to talk about here is how we take these things and incorporate them into an outcome hierarchy. And this is what an outcome hierarchy looks like. So what we're really, if you, in any sort of business, you have at the top retaining profitable customers, which is really comprised of customers that are ready to buy, optimized product and service portfolios, and delivered customer experiences. So these are the things that help you retain customers and make them profitable. And you can see that over here, you might see this is the high-level targets you might find on a balanced scorecard. I have the trade-offs associated with the customer portfolio, and here's the trade-offs with the order to cash process. And then we can actually distill this all the way down to a departmental level. We can incorporate supporting processes. So this is a little bit different than like a business process framework that you might look like, because it's articulated in terms of outcomes. But these can all be drilled down into processes. And the other thing to note here is that what I've actually done here is I've really, from a strategy and a balanced scorecard perspective, I've essentially separated a scorecard into two parts. One, which is the ongoing outcomes that you're really trying to deliver that many that might see on a strategy map, and I've separated that from the changes that companies are trying to implement by way of projects. So what I'm trying to get across here is that by using this framework, you can translate your business objectives all the way down to the front line. So you're on the left side, you're saying, what is it that we're really trying to achieve? And you can translate all that down. And the roll-up is, what will it cost, and can we make a profit? And this dialogue is often not happening either at all or not happening very, very effectively. And this is what this outcome framework allows you to do. So what this slide talks about is really this side of the maturity model that I've developed. So from a profit and strategy alignment perspective, this is really what I call the fragmented part, and most companies are really kind of sitting at 2 and 2 here. But when you get to the third stage, you've incorporated matrix management, process trade-offs, business process framework into your planning systems. The next level is how you incorporate outcomes and the hierarchy and trade-offs into that level. And then at the end, the highest level, you're actually governing outcomes with decision rights. So this is the maturity model I've developed for the profit and strategy alignment. So the key takeaway here from this is that the hierarchies and the frameworks I've talked about here really embed process and outcome thinking into your processes. They translate strategy and business objectives, and this whole approach here really is the foundation for engineering cost structures to deliver target margins. So the next thing I wanted to talk about was the planning models and prescriptive analytics. And I have another article which is in what's called an FP&A Trends website, and I'll give you a link to it, that it really talks about different types of planning models. So just from an outcome perspective, I talked about this framework in the last section, but at the end of the day, you can't really govern what you can't plan. So in order to institutionalize these frameworks I've been talking about, you got to be able to embed them in a planning process. So this productivity management that I showed you and these outcome hierarchies need to somehow be embedded into your planning process. And this is what we want to talk about here. So one thing I want to talk about here is what an integrated planning model looks like. So what you see on the screen is actually, I think one of the things I mentioned at the beginning was that I work for a prescriptive analytics software company, and this is an illustration that we used here. But there are different ways of describing these sorts of models. Some call them a flow-based model, which is really just an advanced form of driver-based planning for those of you that are finance people listening. And this is really what like prescriptive analytics tools do, and optimization tools actually utilize this same sort of framework. But what they really do is translate customer needs into required resources. Now, in the article, I've gotten into a fair amount of detail about, maturity level of different stages of models. And I think most companies are sitting, like from a financial perspective, are sitting at a 2. And this is the article. You can read it. But what I want to talk about are just kind of a couple things here. So one of the just from a finance perspective, if you look at, like, I'll just talk about the manufacturing sector. One of the biggest problems that companies have in the manufacturing sector from a finance perspective is cash flow forecasting. And when you get a lot of changes to a business and you're moving products back and forth across legal entities, it becomes hard to forecast cash or do anything without understanding the flow of inventory. So you need bills and routings actually to support some of these things. The other important distinction about these models is that they connect upstream and downstream drivers. So as your mix changes upstream, traditional models, the flow downstream doesn't automatically change. So if you change the mix, it may change things happening in your call center, or in your warehouse. But the thing is, you've got to be able to connect them to really understand. So a couple of other things that these tools do, they incorporate things like step change cost functions, and like I say, the processes can be executed across legal entities. Now, this is a slide that I used back in the old company, but one of the things I wanted to be able to tell you is that, these processes release significant value. So in a couple of cases at this company, we actually had case studies where we saved companies more than $1 billion, but mostly they were kind of in the $1 to $200 million range, but they were big sums of money. And the reason why these funds or these sums of money were there is because most processes are still fragmented and siloed. So especially financial planning processes. So if you've got a global supply chain, so if you've got a company that's operating across, you've got, parts assembly in one country, you've got raw materials in another, assembly in another, you got a call center in another. You can't possibly help but sub-optimize if you've got, traditional vertically driven financial processes. So it's just a byproduct of the fact that we're using these outdated processes to support global companies. So just getting back to this model, one of the things to note is that, these models, you can see different formats of this or illustrations of this on the internet, but essentially these are just really sophisticated activity-based planning models. That's really what they're doing, is planning activities. And what we really want to do is we want to take these hierarchies that we have, which are these customer-driven hierarchies, and simulate them and through the process. So we take, here's what the customer wants, here's what it means to our production. And then not just in the supply chain, but we want to be able to link all these things to all the various processes. So in fulfill demand, we want to be able to take the driver volumes over here and drive them into these activities and into our core and support processes. Now, this is a really important slide, because I think that if you look at supply chain planning models, like these are some of the things that if you look at companies that provide or integrated business planning solutions and who have like optimization tools, these are the things on the screen are the things where they really kind of fall down. So the things that get really important is like, how do you take this outcome, how do you take this model related to an outcome hierarchy to a chart of accounts, and also drive the cash flow reconciliation. And also don't forget that you're probably going to have more than one model. So from a strategic perspective, if you've got 100,000 products, you're probably not going to want to model 100,000 products. You might want to model at a product family level with maybe 500 or so. So, but if you want to have a process that people believe in, you better be able to reconcile those two things, because if you have a detailed model telling you one thing and a high-level model telling you another thing, people probably aren't going to believe it. So these are the things, like when you talk about integrating financial and operational planning systems, and especially when you talked about supply chain planning tools supporting integrated business planning, this is the thing where they really fall down and are really a key point. Now, one of the things that these tools do, there's a lot of words on this screen, but if you just kind of look beyond all this, these are some very complicated questions. So if you're trying to do scenario planning that looks at all aspects of the business, what you're really trying to do is simultaneously identify both financial and operational constraints and risks. And you've got it. What that means is that these questions are things that you want to be able to identify simultaneously, because if you do them independently, you're probably going to miss something. And that gets even more difficult when you have a whole bunch of changes going on to a business. So if you have a major addition or loss of a customer, changes in demand, I mean, these things just make integrated scenarios so difficult to do. So if you look at, especially in finance, you find companies doing most of their scenario planning on spreadsheets, and they really don't have anything remotely close to something like this to support them. So now getting back to the resource quantification side of the maturity model, as you start thinking about where you go next, the first thing you need to be thinking about is, do you have one model and process? But most at this level, a lot of these models are vertically driven, which means that you're not connecting upstream and downstream drivers, and you're kind of maintaining them department by department. The next level is having one flow-based model, a prescriptive analytics model that's driving a horizontal planning process. And at the top end, this is where companies utilize these same models to optimize performance, which means you kind of start from the bottom and say, look, if I want to achieve a certain amount of free cash flow, what product should I be selling in what mix? So you're using the system to actually help you figure out what your mix ought to be and what you ought to sell. So the key takeaway from this section is that, the need to share one model, both at a detailed and a high level, and what it takes to use such a model in a process. So from a scenario planning perspective, you want to be able to simultaneously answer complex questions, and you want to be able to do it across legal entities. So, especially, if you have global companies where they're highly interconnected, you want to be able to answer these questions across entities. So that's the planning and prescriptive analytics part. So what I want to do here is just illustrate how this gets embedded into a process. So the first thing is, I just want to highlight the fact that this is in fact a process, and that you can actually embed it into one, and that you're capable of supporting one. And one of the key things about this process, and I'm going to go back to the example I showed you very early on, is that at the core of this is how you simplify this for the department manager. So you don't want to have something so complicated that a department manager is not going to want to use it. So the example I gave you earlier about why this department manager wanted to use it was because it was solving a problem for them. So this whole process is built around doing this for every department manager to make the whole planning process much more fluid. Now, a key part of that is how of this process is actually embedding process management into a rolling forecast process. So from a sales and operations planning perspective, you'll know that a lot of companies, or what companies do, is balance supply and demand and look, do I have the right resources? Essentially, we're doing exactly the same thing at a process level. And now, as we incorporate these other things, we can incorporate project forecasting and segment forecasting into this same process. Another part of this is incorporating activity-based costing into a rolling forecast process. The hierarchy I talked to you about earlier gets embedded into how you actually quantify the resources. So you're using the integrated model to drive the resource quantification. And if you look at this model I shared with you before, it has a huge impact on your ability to make these changes within the processes. And one of the reasons why this is what's really happening is that by using a prescriptive analytics tool, you're actually able to establish what I call concurrent versus sequential processes. You're able to really collapse the cycle time of the planning process. And what this means, especially from a sales and operations planning or integrated planning perspective in the manufacturing sector, is your cadence of your process meets the needs of both finance and operational stakeholders. And this is a huge problem for a lot of companies, is that, if you don't have the right model, it becomes hard to do all this stuff within a monthly cycle. So by using a prescriptive analytics model, you can not only can you meet the cadence, but now you have time to actually do some really value-added scenario planning. It's no good if you can only do one scenario and you've got 4 hours at the end of a month to be able to do it. You want to be able to have time to actually think about your business and understand potential risks associated with the business. So what I showed you here is a process that embeds a whole bunch of things that you may be familiar with. All these terms, all these things I've actually embedded into a single process. And what this process, is like from a manufacturing perspective, what I'm really doing is integrating a rolling forecast with sales and operations planning as part of a single workflow. The other thing is that cash flow, working capital, and foreign currency exposure forecasting is just simply a byproduct of the process. You shouldn't have a separate process. Scenario planning is done as part of this process. And a big part of what this process does is it allows cost structures to self-adjust to changing market conditions. So a few key changes to understand about this process is that, the whole planning focus is shifting from functions and entities to processes and outcomes. You've got a sequential, concurrent versus a sequential process, and it's an end-to-end versus a disjointed scenario planning process. And some key enablers of this is that, the whole idea of model ownership is shifting away from, having just in finance to how you engage your department managers in maintaining it. And all your key assumptions are maintaining the various model parameters. So some fairly significant changes. So the key takeaway from this section is that, I think that there's some key changes that reflect or comprise integrated process, and there's some very specific capabilities that enable it, which I showed you. And prescriptive analytics plays a central role in this process. Now, in terms of design, one of the things that's really important, I'll illustrate with a case at the end. It's really important, to do the upfront design part and understand how you're going to support one rolling forecast. Because if you don't, you're really gonna set yourself in an incorrect direction. And I'll illustrate that with a case. So let me now turn to maturity model. So I've talked to you about elements of the maturity model. So what I want to do is kind of bring this together into one maturity model. And I have an article that's actually being published this week that really summarizes this whole maturity model. So I'll actually share that with you as well. So at a high level, this is how I think about maturity models. So at a level 3, we have connected processes where we start embedding the idea of process management into our processes. The next point was what now we understand how outcomes, or in how we translate like scorecards and trade outcome related, customer related trade-offs into this process, and how we translate it. And ultimately we get to a point where we have what I call optimized portfolios, where our decision rights all shift from functions to processes and outcomes. And this is at a point, really, what we talk about in this high level section is how we plan, manage, and govern outcomes. Now, I've talked to you about a lot of different capabilities, but there's really kind of four that I've talked about, which really comprise what I call a complexity gap. And we've talked about having connected outcomes and trade-offs through the hierarchies, governing those outcomes across entities, integrated scenarios, and concurrent process. Like, there's many detailed capabilities, but I mean, these are the four that you really ought to focus on. Now, what I want to just talk about here is that if you look at where most vendors are at, they're really here at this X level. But the thing is, I know that what's technically possible can be done here. The problem is that what you're not going to do is you're going to find it in the vendors that you're typically you may be familiar with. And as well, a lot of companies articulate these strategic aspirations, which might be up here, but when it comes to technology, they actually end up here. And one of the reasons for this, so if you look at the way technology analysts typically view the market, they typically review it from a functional or from an application perspective. And one of the challenges with doing that is that while you may have a vendor that's categorized as being a leader, when you look at it from a business process perspective or a management process perspective, this is where they're at. I'd see a lot of vendors, and I found a lot of frustration there actually as well with kind of financial executives where they say, gee, I'm really confused. I'm using what these technology analysts refer to as being kind of leaders, and I'm still stuck where I'm at. And one of the challenges that you'll find, some of the comments from a financial perspective, is that if you look at strategic CPM vendors, you'll find there's not a single one out there that uses prescriptive analytics, and this is one of the reasons why, I think that a lot of companies are having problems with their financial processes. And then from a sales and operations planning perspective, one of the problems that supply chain vendors have is how to take what they're doing and support an enterprise modeling, not just supply modeling, but how do you support the entire business? Because I think most focus on, if you look at supply chain models, they cover maybe half of the business. So they're really not as integrated as they might claim. So this is me just kind of summarizing how I'm kind of looking at it. If you look at the marketing going on with vendors, I think I'm just seeing a lot of the same old stuff packaged up in a new way. I'm not really seeing kind of a lot of new things from some of the traditional vendors. And one of the challenges you find is that there's some, finance and operations. What I find are they're designing applications in silos. So they're basically throwing things over the wall. And the things that are falling between the cracks is how do you use prescriptive analytics to support both finance and operations and the whole notion of outcome and trade-off management. There's some huge things falling between the gaps between financial and operational applications, and you really have to be cognizant of this. And really what we're talking about here, if you look at the innovation and adoption curve that you may be familiar with, if you look at, the various software applications like integrated planning or integrated financial planning, I think in complex organizations, you're really kind of in the late majority stage. But really, when we talk about integrated processes, we're really talking about, the analogy I would use, what happened to ERP 30 years ago, I believe is now happening to what I call management systems. So, or processes. And I'm not sure if this is the right term. And, one of the problems, we don't even have a common term to describe this. But this is where I believe that organizations are going, or especially or need to be going from a management perspective. So the key takeaway from this is that I've provided to you an overview or a framework for understanding what full integration means. I've talked about four incremental capabilities that comprise what full integration is. Now, and from a technology perspective, there's some gaps in mainstream tools, but I think the technology currently exists to support the types of mature processes I've been talking about. So I want to come back and talk about a case study that will help kind of glue all this together. So this particular company, it's a big company. They're in the midst of shifting from a commodity to a specialty products business. Um, they have an ongoing operational excellence program, and one of the things they've done is to launch an IB integrated business planning project to drive the strategy. Now, one of the challenges with the approach that they've taken, and like I kind of think about two types of approaches. There's a technology-led approach where you basically say, I'm going to buy a piece of technology and have them tell me what processes to use, and I'm going to use those best practices. And this is sort of the analogy of an ERP system. Like ERPs are now at the point where you can take this approach, find an ERP vendor, use their processes. But the problem is that I don't see a single vendor out there that really has this kind of vision. So if you do what this company is, it's a technology-led approach, chances are you're not going to get where you want to go. So you're going to end up here hitting this wall. So in this particular company's case, they're inferring this direction with what they've said, but they're actually headed in towards this direction. And what's going to end up happening, from a tactical, this talks about this is a tactical approach and this strategic approach. So what they're taking a tactical approach that's going to take a long time to implement and time to realize value. Plus, they're not going to realize the amount of value that they want to get, and it's because they haven't addressed the challenges or the questions shown on the screen. And the main one being a few of the main ones are like, what does the endpoint look like? They still don't know that. They don't know where the value really lies, and what changes actually underlies this value. And as well, if you look at the very bottom, like they still haven't answered the questions, what challenges does the solution address? So I told you I'd come back to this screen, and here's where we come back to it. There's a few things, like if you're going to get into like an integrated solution, one of the things you ought to be doing is solving problems for key stakeholders. So like I'm going to pick start with a finance. One of the things that, the finance people want are things like scenario planning. They want cash flow forecasting. And if you look, especially in the manufacturing sector, if you look at two problems that the finance people often articulate, and despite all the technology that many have implemented, those are two critical problems that most financial executives struggle with. So if you can't hit those two things, you're probably not solving the problems for other people. So on the operations side, one of the things that companies want to be able to do is establish accountability for customer profitability and inventory investment. And that goes right along with the ability to manage functional silos and profit and cost structure management on the finance side. So the key takeaway here is that these challenges that you see on the screen, the likelihood of an individual financial, operational, or strategic executive trying to address these things on their own is pretty low. These things are all highly interconnected, especially I would say the vast majority of them, you get into complex organizations, you're probably going to need prescriptive analytics to solve them. So for this particular company, one of the things I wanted to mention here is that, one of the things that, as complexity gets higher, one of the things that like from a sales and operations planning or integrated business planning, that at a tactical level, the value proposition really is about supply and demand balancing and making sure that you have a sufficient inventory. But as you get into more complex settings, especially if you're getting into specialty products that have fundamentally different cost structures, what you're really looking for to drive the values and your ability to manage outcomes. And from being a little bit more specific, how do you manage the customer profitability? So you want to be able to have effective ownership in your business and accountability for your inventory investment and your service levels. And this is where all the value lies. And this particular company is really heading in this direction as opposed to heading this direction. And one of the problems is that, they've been their objectives really aren't as clear as they really ought to be. But if you look at some of the things that they're really trying to do, they're over here like profitable growth with specialty products, and you can read them all. But these are really the key requirements to meet those objectives. And one of the things that you just don't see that in terms of how they've actually defined their requirements are really some of the key things that are driving the value are missing in the requirements definition. And especially if you're trying to drive digital transformation, these are the things that you ought to be looking for. So one of the things I'm seeing in response to all this, especially in the manufacturing sector, is I think companies who've implemented sales and operations planning or implemented all the various technologies I've talked to you about, there's a shift, especially from integrated planning, shifting from the supply chain to either the chief operating officer, the chief financial officer, or those leading operational excellence. Because one of the problems in a lot of sales and operations planning or integrated business planning processes is that they really aren't connected to finance. To me, and if it's not connected to finance, you're really not describing decision making. So while the processes are connected, they're still separate. And what you really want is one process and one workflow that's focused on managing outcomes and actually really eliminating functional silos. So there's a huge difference between this tactical approach and a strategic approach, which I think really requires a much more holistic view and somebody who had, somebody to lead it that really understands the business as a whole and how value is created. And so one of the key takeaways from this is that if you don't think that you've got the right direction, leadership, change strategy, and understanding, if you're not doing this, you got to stop what you're doing and kind of really think about it, because otherwise you're heading at 100 miles an hour into a brick wall, and you're going to make the same, make the same mistakes as others, not really kind of learn from them. So let me just quickly kind of summarize what we've talked about here. At the very beginning, I talked about what questions, the questions that we were going to answer. So I think I talked about what problems that we're solving, what these integrated processes are worth, who benefits, what comprises them, and the incremental capabilities. And hopefully I've imparted like how do you take these integrated processes and institutionalize the OpEx principles like systemic thinking, customer centricity, all these things into one process. Now, as I told you before, I've just kind of provided you like a high-level overview. I would expect that I probably create a bunch of questions in your mind that you really need to find answers to, and that's really one of the things I was trying to do to help you understand what you need to understand. I've given you some key ideas to think about. So managing trade-offs, the outcome hierarchy, the integrating financial operational models, embedding these things into a process, the maturity model, and key process changes. Those are some things that you should be thinking about. Now, I put this slide in here because this stuff is really not new. These ideas, if you look at the Harvard Business Review, they've been talking about this stuff for years, and there's been some things talked about, especially like great companies obsess over productivity, employee engagement. One of the things I hope I've gotten across here is how you can actually address these things with a management process. Now, one of the things that I'm going to put up on LinkedIn, what I'd like, for people as part of the OpEx Society, that I'm going to put out some questions that we can talk about. So, for example, do you guys use the term management process and system in your business, and who should own the management system? These are some things I think that would be very useful discussion points, and I'd be interested in your points of view. So that is a summary of what we're going to talk about. I hope that you found it helpful, and if you need to get a hold of me and talk about anything, feel free to do so. I didn't get too many questions here, but one was, is it possible to get a PDF of the materials? Yes, but one of the things we'll send out the video as well, so you can actually listen to the whole thing again. So I think at this point in time, given that there's no questions and given that we're at the top of the hour, I'm going to say thank you and close off the webinar, um, and thank you for attending. Thank you.